The market is now open and we have another day of terrible earnings, and this one is in the healthcare sector. As we can see, quite a lot of them down very poorly. ELV 13%, CNC 10%, Molina Healthcare down 12%, and today our focus is going to be on ELV. Now, they reported this morning before market open, and right now we can see the market didn't like it one bit. It is down around 12.5%, trading right now towards its 52-week lows, and we can in fact see Wall Street have been very historically bullish on this company. A strong buy from Seeking Alpha with a hold from Quant. This is also one we hold in our own portfolio, so we're going to dissect what's gone wrong here and if we believe now is a golden opportunity and the market has overreacted. First thing to note here is that their profit does fall short of the expectations. We see higher medical costs, not something that we like, and in fact here a soft issuance on the annual outlook, so pretty much a triple whammy. Profits down, costs gone up, with guidance going down. Now, when we take a look at their top line revenue, that was a beat, so nice to see. In fact, up around 5.3% year on year, as well as beating analyst estimates of 43.3. As we can see, their number coming in marginally higher. Nonetheless, a beat is a beat. And then when we take a look at what's gone wrong here, first thing to note, the benefit expense ratio, we ideally want to see lower. It is better for companies in this industry. Actually increased by around 270 basis points. So again, not something we want to see. And when we look in terms of the actual profit, we can see the profit is down 21% to around 1 billion. And one of the main issues here is that earnings per share, which did in fact miss 837, not only down from a year ago at 899, but massively missed the mark of the analyst consensus at 966. So we have profits down, we have earnings per share missing massively, not even just lowered from the previous year, but that is a very significant miss. And we can also see their medical memberships are down around 1.5 million. That's around 3%. So this is a very tough time for this company. So we can in fact see why this has been heavily hammered by the market. And the final thing that we do want to point out, again, unfortunately, more negative news, is that they forecasted an annual EPS of $33, which is below the guidance they initially discussed around $37.20. So lots to really ponder for ELV. As we said, it is down around 13% just right now. In fact, it was down further upon market open. In terms of the performance over the last year, it is down 6%. Over the last 10 years, it still has outperformed the S&P up 263%. It does also offer a yield of 1.31%, and we can see forward P looking very low, especially when you consider the S&P right now trading around 25. In terms of their estimations moving forwards, well, it's not been updated yet, but this was a substantial miss in quarter 3. They do anticipate over the next 3 quarters growth to the overall earnings per share, but again, very worrying. In fact, when we do look at the previous 4 quarters, whilst there was a beat, a 100% track record, they did miss in quarter 3, and as we saw, they expect this now to be around $33. They still expect growth moving into December 2025, which will ultimately lower the forward PE for next year. Question is, do you have confidence in essentially all of these faltering numbers for ELV? So lots to think about. So let's dive in firstly to their underlying metrics. We get a 99 dividend safety score, highest score obtainable, severe undervaluation on dividend yield theory, which we'll uncover shortly, and we also note severe undervaluation based on the forward P. Love to see this, as we will show you. This is a company that does historically increase the dividend at a double-digit rate. As we can see, this was reaffirmed a couple of months ago, essentially highlighting the fact that a dividend cut for this company is highly unlikely. Now, how did they perform in the Great Recession 07-09, the more recent one? Well, no dividend was paid, so no comparative data. They had above average growth in terms of the comparison to the S&P, -4 versus -12, but they did marginally trail the S&P's total return, -61, S&P -55. As we said, they do historically increase those dividends at a double-digit rate, with 15% on average every single year over the last 10 years, and they've been increasing those dividends for the last 12 years consecutively. Now, in terms of looking at the undervaluation, what we note over the last 12 months is pretty much been trading within the blue bucket, which is the expected fair value. Right now, though, this has gone right beneath it. So this is a good sign to analyze this company further. We are seeing some undervaluation based on this model, but as always, we will conclude towards the end and we will run it through our own valuation. As we said earlier, dividend yield theory showing undervaluation. That is when the company's yield is above the 5-year average. As we see here, 1.49 versus 1.22, and we get another undervaluation with the forward P of 11 sitting substantially below the 5-year rolling of 14. We also note it is significantly lower than the healthcare sector P overall of 16.3. You may argue though this company does deserve to trade at a discount given the poor performance in comparison. Again, something we need to consider. In terms of free cash flow, as always, we choose that over the earnings, which is susceptible to manipulation by management through accounting. Below 60% every single year, 21 in 2023, 21 over the next 12 months. So it's clearly obvious how this company can continue to offer double-digit increases, something we do anticipate to continue moving forwards. When we look at their free cash flow, as always, consistent increases is what we want to see. We don't get consistency, but we do note it has pretty much tripled from 2014 to 2023, and a small increase is anticipated over the next 12 months. In terms of sales growth, 3 to 7%, as always, typically what we want to see. They've pretty much done that at the bare minimum. Last few years looking very, very strong. We do see on a trailing 12-month basis at 4%, therefore indicating, and based on the quarterly report, that this is going to drop quite substantially from the previous year. Nonetheless, when we do look at it from a perspective of the last 10, we can see it has more than doubled, 74 billion to 171 billion. And we also quite like about this company the fact that they are doing share buybacks on a year-on-year basis. Whilst not massive amounts, nonetheless, they're returning excess cash to investor pockets. A very nice bonus because this company also increases those dividends at a double-digit rate. We then move on to the ROIC. As always, 10% or more, give us faith, management can effectively allocate their capital. They're doing that with no issues whatsoever in the mid-teens year-on-year, 15% in 23, 14% on a trailing 12-month basis, and as always, that will make it attractive for investors to consider. Now, operating margin, we want a minimum of 12% that we don't see. We also want operating efficiency over the longer term. Again, increases to the margin, not something we see, but very typical with other companies in this industry like UNH. They don't typically have very high margins, and therefore this is something that we just have to say is in line with the industry overall. In terms of the free cash flow margin, straddling around the 5% on a year-on-year basis, 4% in 2023. We then move on to the net debt to EBITDA. One of the things we love about this company, the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. We get 0 right across the board. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. Not even one day over the last 10 years. Not even one day anticipated over the next 12 months. Very strong balance sheet and also correlates to dividend safety. So no surprises whatsoever why this company has that 99 very safe score. We also want to point out we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we talk about essentially what's gone in the market over the last few days, as well as undervalued companies that we do believe deserve your attention. So do click on the pinned comment below where you can sign up and read straight away. You'll also be able to gain access to 36 undervalued stocks for the month of October. We run through a lot of information for each one of these, talk about the upside that we see according to Wall Street, and we also flag those that sit within our own portfolio. And this month you can grab 22 dividend stocks that have the most upside according to Wall Street. So as we said, click on the pinned comment below, sign up, and you can read straight away. Other parts of our analysis include looking at insider institutional movement, 0.35% in terms of insiders, 25 million worth of sales. This is just over the last year. We don't notice any movement in the more recent quarter, but we see around 18 million of sales in quarter 3, 7.5 in quarter 2, and just under 400,000 in quarter 1. Now, in terms of who these insiders are, well, we can in fact see the more recent one, 5th of August, you could pretty much say pretty outdated. That netted him around $400,000. And as we would always say on this channel, insider selling isn't bearish. They sell for many reasons, personal, financial. What we're trying to flag here, if we can see, is insider buying, very bullish, because management buy because they believe the share price will ultimately go up. In terms of institutions, well, around 90% ownership, $5 billion worth of sales over the last 12 months. We see a lot more buying, around 8.4 in comparison over the same time period. But in quarter 3, the more recent one for institutional data, we see more selling, the opposite to what we see in the 2 previous quarters in 2024. But remember, as always, do your own due diligence. Regardless of the fact that institutions or insiders are buying or selling, this is something we can add just as one layer of our overall review. Now we're going to jump into the income statement. As always, we have already taken a look at their top line revenue. We want to flag their bottom line story, and what we can see, nice consistency in terms of the growth. We've already covered this. In fact, more than double from 74 billion in 2014 to 171 billion in 2023. What we want to identify here is, does the bottom line follow suit? And from a graphical basis, we can already say it pretty much does. A little bit of inconsistency on a year-on-year basis, but we notice it's more than doubled. 2.6 billion in 2014, 6 billion in 2023. So that is a good sign. Then we get to the health of the company, total cash versus total debt. Similar to other metrics of revenue, bottom line, net income, cash has also been increasing, around 2.2 billion in 2014, going to around 6.5 in the latest quarter. Now, in comparison to their total debt, numerically and directionally, otherwise one metric tells us nothing, we can see their total debt in similar fashion has been increasing, 16.6 billion in 2014, 30.3 in their latest quarter. So debt is rising, something we do need to consider, but as we saw earlier, net debt to EBITDA has been 0, so overall it does look okay. Then we want to look at some gradings. The first one, valuation, where they get a D+. As we already said, their P in comparison to the sector is very low, 13 versus 21. Essentially, you are getting around a 40% discount if you are buying this company right now, and that is pretty much shown throughout depending on whichever valuation metric you use. There is the odd one that does show the opposite, but as we can see, overall this company does trade at a discount. Then we get to the growth where they have a D+. Revenue year on year, 4% versus 7% of the sector, not looking good. In terms of moving forwards, 6% versus the sector, 8.32. And we also note the earnings per share over the next 5 years, expected growth of 12%, not far off the sector of 11.31. So not looking too great either. We can start to maybe see why this is trading at a bit of a discount. When we get to their profitability of an A, gross margin very low in comparison, 28% versus 58%. Bottom line, 4%, that is very good to see when we can consider that the sector median is negative by around 4%. We then move on to the final one here, the cash from operations, 2.1 billion, a lot better than the negative 14 million from the overall sector. So there is a lot to think about with this company. There's lots of pluses, but also lots of bearish indicators. And as we do reiterate, a buy signal from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, D+ on valuation, D+ on growth with an A on profitability. Now, how do they compare against others in the sector in the managed healthcare? We have CNC, Humana, MOH, as well as some others that are very well known. Over the last year, it is down 6%, but what we actually notice, pretty much every single other competitor is also down by quite some consideration. So as a whole, the industry hasn't been the greatest. And over the last 5 years, we do see this has performed actually the second best, up 87%, even after today's double-digit drop. And when we zoom out over the last 10 years, 311% still outperform the S&P, and as we can see, outperform nearly every single other company. So there are positives based on historical performance, but remember that the past performance doesn't determine the future. We also want to flag here, it has outperformed the S&P over the long term. Over the last 12 months though, clear outperformance by the S&P. Over the last 5 years, we can see the S&P has marginally underperformed, and over the last 10 years, as we have already shown, this company has been very strong. Is this a great buying opportunity? Has the market overreacted? Let's jump into our valuation. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Now, our intrinsic value of $567, we've run it through 3 models, the multiples valuation, companies in a similar sector and size. We have the average P multiplied by the EPS of ELV to give us our first undervaluation signal. But as always, do remember, we're not looking at any one of these models in isolation. We then have the dividend discount model, as we already ran through, very nice growth to their dividend, average around 15% over the last few years. We've gone very conservative at 6.75, so we have our second undervaluation. We then move on to the DCF model, free cash flow year on year, Average growth 18%. We've gone a lot more conservative than analyst targets. At the 6% with a discount rate of 8%, we have the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, our third undervaluation signal. So today's intrinsic value is the average of these three models, as we said, $567. And as always, you can grab a copy of this model by clicking on the pinned comment below, running your own numbers where it is for ELV or any others. As typical on this channel, we start off with a margin of safety with 10%. Execute on this if it has a wide moat, strong financial metrics, and good forward-looking data. If you believe that, a buy at 510. Then we keep going till it's near the current trading price. And in today's episode, you can see it isn't far off a 25% MOS, but right now you are getting at least 20% up to $454. But remember, there are some bearish indicators that it isn't going to perform that strongly over the next few quarters, something just to consider. But even Wall Street, after revising their price target, which was above $600, now sitting at $585, still a strong buy signal with 36% upside anticipated over the next year. This could be one to definitely consider, especially for those who love their dividend growth stocks. It's outperformed the S&P historically. It's historically increased the dividend by double-digit rate, and unless you think there are any massive fundamental issues with this company moving forwards, it could definitely be one to consider. Now, as I've already mentioned at the beginning of the episode, this is one that I have in my portfolio, and if we do see it come down to around the 25% MOS at $425, down to around $400, this is one that I personally will continue to add because I do believe the market has somewhat overreacted, although we do also have to consider the performance has been very poor. As we said though, at least a 20% MOS, 36% upside over the next 12 months from Wall Street. Give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.